How much money will you be paying in taxes this year? Hopefully, the lowest amount legally possible. And to help you do just that, I'll be going over the 12 most overlooked tax breaks you can take today. The more tax deductions and credits you get, the more money you get to keep in your pocket. So hold off on filing your taxes until you've gone over the entire list, because there is money saving tax breaks here for everyone. Note that this video is for educational purposes only, and you should contact your accountant or legal professional for specific advice for your situation. Let's dive in. Hey, I'm Quran from Life Accounting, where we help businesses increase profit and lower taxes via smart accounting and bookkeeping. So the first tax break on our list, 0% tax on capital gains. The 0% tax rate has been in effect since 2008 and allows you to realize the gains from your investment completely tax-free. So who is applicable for a 0% tax rate on capital gains? To find out, simply look at the long-term capital gains tax chart. If filing taxes for 2020, married couples filing jointly who make up to $80,000 in taxable income, or single filers who make up to $40,000 in taxable income. Now for 2021, the income limits rise to $80,800 for married couples filing jointly and $40,400 for single filers. Something to note is that this only applies to long-term capital gains, which are gains from investments held longer than a year. Short-term capital gains are taxed as ordinary income based on your federal income tax bracket. Okay, tax break number 2, the child care credit. If you have a child under the age of 13, you may be able to get up to a 35% credit for all or some of your costs for childcare. Now, the credit is known as the Child Independent Care Credit, and the limit is $3,000 for one qualifying child or $6,000 for 2 or more. The actual percentage of your credit depends on your income, but the credit does not phase out completely for higher earners. To be eligible, the cost for childcare must be so that you and your spouse, if married filing jointly, could work, seek employment, or attend school. But here's a pro tip. Household expenses such as paying a cook or a cleaner counts as a qualifying expense. Also, the credit is not only for children, but includes any care for a dependent, including your spouse, 13 or over, who is physically or mentally incapable of caring for themselves. Let's go over a few tax breaks for the homeowners out there. Tax break number 3, mortgage points deduction. So mortgage points, also known as a loan discount or a loan origination fee, are mortgage interest you pay up front when you take out a mortgage. If you pay points on your mortgage, there's a good chance they are fully deductible in the year they were paid if the mortgage is for your main home. In general, if you paid points to refinance or paid points for a second home, you will have to deduct the mortgage points over the lifespan of the loan. Meaning, on a 30-year mortgage, you would deduct 1/30th of the points paid each year. Here's another pro tip. If you pay off the loan early, you can deduct the remaining mortgage points in the year you pay off the mortgage, unless you refinance with the same lender. If you do, then you will need to deduct all remaining points over the life of the new loan. Okay, here's another tax break for homeowners. The mortgage insurance premium deduction. If you get a conventional loan and put less than 20% down, or refinance with less than 20% in equity, your lender typically requires you to pay monthly private mortgage insurance, also known as PMI. While the extra cost may sting, if you itemize during tax time, being able to deduct your PMI may make you feel a bit better. The deduction starts to phase out after $100,000 in adjusted gross income and disappears completely after $109,000 in adjusted gross income. That's $50,000 and $54,500 respectively if filing married but separate. All right, another pro tip. This deduction is scheduled to end after 2021, but may be extended as it has in the past. Tax break number 5, mortgage interest deduction. The mortgage interest deduction allows you to deduct the amount of interest paid on your home loan during the year. If you purchase your home before December 16, 2017, you can deduct the mortgage interest paid up to the first $1 million in mortgage debt. If you purchased your home after December 16, 2017, you can deduct interest up to the first $750,000. In most cases, those in a higher tax bracket will see the biggest benefit from this tax break, as they will receive a larger deduction. All right, tax break number 6, residential energy credit. If you installed appliances or made improvements to your home to boost energy efficiency, you may be able to get a credit for the associated costs. Solar, wind, geothermal, and even fuel cell technology are eligible for the residential renewable energy tax credit. This includes items such as energy efficient windows, doors, and solar power water heaters and roofs. The tax credit you can receive is a percentage based on the cost of equipment, including installation costs. Here's how the tax credit works. You get 30% credit for system placed in service by December 31st, 2019, 26% credit for systems placed in service after December 31st, 2019, and before January 1st, 2021. And lastly, you get a 22% credit for systems placed in service after December 31st, 2020, and before January 1st, 2022. Note that currently the residential energy credit expires at the end of 2021. But I got another pro tip for you while it's still here. Both existing homes and new construction homes qualify, but rentals do not qualify for the residential energy credit. All right, if you own a business, the next few tax breaks are for you. Number 7, the IRS minimal rent use rule. If you didn't know, the IRS allows you to rent out your home to your business for up to 14 days per year, completely tax-free. But when doing this, be sure the rental rate you offer your business is actually reasonable. A good rule of thumb would be to call local hotels and event spaces and inquire about the rates. You'll want to keep documentation of both your rental rate and meeting minutes as evidence. Here's a pro tip for you. Anything over 14 days will require you to report all rental income, so be sure to not go over the 14-day maximum. Tax break number 8, the home office deduction. Business owners who work from home have the chance to save pretty big on taxes by taking a home office deduction. If you use a portion of your house, apartment, condominium, mobile home, boat, or similar structure regularly and exclusively for business, you can write off associated rent, utilities, real estate taxes, repairs, and maintenance, amongst other things. Unfortunately, employees who work from home are not able to take advantage of this deduction. Tax break number 9, student loan interest deduction. If you're a college student or parent of a college student who took out a loan to pay for school, you may deduct up to $2,500 in paid interest. The loan itself had to be used for qualifying expenses such as tuition and textbooks, and not for expenses such as room and board or transportation. At this current time of this video, interest on federal student loans have been suspended since March 13, 2020. If you paid any interest before that date in 2020 or have private loans, you are still eligible for the deduction. Tax break number 10, the lifetime learning credit. Another rare tax break available for students is a lifetime learning credit. The lifetime learning credit allows college students and parents of college students to get up to $2,000 in credit to offset tuition and educational related expenses. To qualify, your tuition and fee payments must have been made to a post-secondary school during the year, aka after high school. You are still eligible for the credits for any post-secondary classes you enrolled in, even if it's not towards a degree. If your adjusted gross income is over $68,000 or $136,000 for joint filers, you will unfortunately not be able to claim the credit. Tax break number 11, charitable deductions for non-itemizers. If you don't itemize, you can rejoice, because previously, charitable donations could only be deducted if you itemize during tax time. But for the 2021 tax year, if you take the standard deduction, you can deduct up to $300 of cash donations you made to a qualified charity or $600 if filing jointly. Be aware that donations of household items or cars do not qualify for this special deduction. This is a cash-only deduction. If you choose to itemize, you can still deduct charitable donations as normal. All right, tax break number 12, medical expenses deduction. Did you know that you can deduct qualified, unreimbursed medical expenses? To do so, the medical expense has to be more than 7.5% of your adjusted gross income. Here's an example. Let's say your adjusted gross income is $50,000. You could deduct everything after 7.5% of your AGI or $3,750 of medical bills, meaning $10,000 in medical bills would allow you to deduct $6,250 of the cost. Hopefully that cleared that up for you. Now, the IRS has an extremely long list of the medical expenses that qualify, but a few examples include payments to an ambulance, crutches, and eyeglasses. Note that the deduction is for unreimbursed medical expenses, so if your insurance company paid for it, you're not allowed to deduct it. There you have it, 12 tax breaks most people miss that can help you save big during tax time. I hope you found this video useful and interesting. If you did, please go ahead and like this video and comment below if I did a good job of explaining. Also, don't forget to subscribe to our channel so you don't miss out on other videos we're putting out to help you lower your tax liability. I'm Karan from Life Accounting. Until next time.